You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
I've never understood this phrase, but I know it's like an 18th century English phrase. It never rains, but it pours. You know, it rains outside.
Yeah.
Sometimes it just rains.
I think what they mean is it just, when it does rain, it comes down hard. That's all.
It doesn't.
No.
Not always. Sometimes it rains lightly. So
okay.
It never rains, but it pours? I don't know. I don't get it. But in terms of my life, today I get it.
Yeah, what's going on? What's the downpour?
Today,
what's
I get it. You know, like flow? Yesterday, I was under the weather.
Yeah.
Then today, I'm trying to record some stuff, and there's a sheriff's helicopter going outside the window.
They finally found you?
I don't know what was going on. It turns out, the schools are locked down. Don't know why. There's a sheriff's helicopter. So if you hear glass breaking and me screaming, please call 911. And then I go out in the front yard to look up at the sheriff's helicopter because I'm stupid. And there's a guy from the water company out there. I said, "What's going on?" He goes, "Oh, you got a leak." I said, "I do."
And that requires a helicopter to fix it?
No, I don't know what the helicopter had to do with that. And so the water's off, and the guy's out in the front yard fixing the main into the house. And then our microwave broke, and I ordered a new one from Costco, and the phone rings, and it's like, "Hi, this is so-and-so from Costco. I'll be there in 15 minutes to install your microwave."
When it rains, it pours.
It never rains,
By the way,
it pours.
Those of you who will call Don, call 911 for Don. I will call ICE instead. So just so you know who's calling whom. So,
you know, my family hasn't been I haven't had an immigrant in my family since, like the middle of the 19th century.
Yeah, but you guys are still wearing your kilts around, so you're good people for, bye-bye.
It's in Florida, it's so much cooler, that air coming up under the
I don't
kilt.
want to know.
Yeah.
I really don't.
It feels so
I don't want
good.
that exposure thought, if you don't mind.
You have to be a little more prim. You can't spread when you're wearing a kilt.
I don't want to see that on the bus, okay, if you don't mind. Yeah.
No man spreading with your kilt. That's not a great idea. Hey, welcome to Talking Real Money, not real rain. I'm Don McDonald. That's Tom Cock, and we are here to enlighten you about the wacky world of money. And, we could just talk literally all day about the stupidity that's out there in the world of finance, both high and low. But one of our true beliefs now, and it didn't used to be that way, by the way, we've evolved. We are evolving creatures. We've become smarter over time. We used to actually believe that maybe smart people could time the market, could get in when it was going up and to get out when it was going down. The company we both worked for believed that for a while. And Merriman, I'm talking about.
Yeah. Well, Paul did build the practice originally on market timing.
Market timing.
Yeah, he did.
But now we truly believe, based on gargantuan piles, giant rain-soaked piles of evidence, that you can't do it. And yet mutual funds and money managers and all kinds of people keep trying to do it. What's most interesting is when you can find a mutual fund that tries to do this, because then you can actually track their track record. And there was an interesting article recently from Morningstar about the folks at Pacer Trendpilot and their ETFs that try to be in when the market's about to go up and be out when the market's about to fall. Is that about it, Tom?
That's about it. And actually, they have a midway point, too, which is kind of fascinating. So they don't go all the way one way or the other. But, that's about right. And the good news for people that invest in this fund is this is not based on intuition. They've got rules. They got rules about this. So and they're going to charge you pretty healthily. I mean, 60 basis points, 0.60, to be in the Trendpilot U.S. Large Cap Exchange Traded Fund. And they use the 200-day moving average. Now, what that means is you add up the market price, right, for the last 200 days. You divide by 200. That gives you a number. Then if the market is above that, then I got to make sure that's right. The market doesn't close below 200 on 5 consecutive days.
Yeah, you're trying to confuse yourself as the system is confusing.
It is. If it closes below the 200 days on those 200-day market, doggone it, 200-day market average, right?
I'm
on
with
5 consecutive trading days, right? Then you're 50-50.
Right. Yep.
And then if it closes again and it's lower than it was the 5 days earlier, then after those 5 days plus more 5, then you're out. Then you're all in cash. So you're either in cash, 50-50, or 100% stocks. Okay, is that a little easier to explain that way? 200-day moving average.
I get it, but I don't need to get it.
No, you don't. Because listen to the numbers. This is from Morningstar. The understatement of the year, the approach, quote, has not succeeded. The exchange-traded fund had gained 8% annually from its June 11th, 2015 inception through May 13th, 2025, which sounds great, by the way, except that's 5% per year less than the S&P 500. Let me say that again. 5% a year less, not 5 not
that's 5% annually.
Annualized. Now, it did reduce volatility. The exchange-traded fund was less volatile, 13.4%. Standard deviation versus 18.5 for the S&P 500.
And that is a significant number.
It is. And
that's
we'll talk about
a big difference.
I'll give you another number to compare that to here in just a moment. It had a smaller maximum drawdown, which can be very important in retirement, a negative 25 versus the index is negative 32. And by the way, I looked it up because I'm fascinated by this. Thank you, Mark Hebner, and the wonderful website IFA.com, because you can look up almost any number there. You go back now 97 years and 2 months and look at a portfolio.
Now, that's longer than the 2015
much longer. Correct.
Inception.
Thank you.
Yes.
Good point. From March of 1928, to the end of April 2025. Had you invested 60% in a globally diversified stock portfolio and 40% in bonds, your return would have been over 9% a year, 9.02, which is ridiculous. Do not count on making 9% a year on a 60-40 moving forward. But your standard deviation, remember this fund's was
that's the measure of volatility.
13.6. So very equivalent.
Almost identical.
I know, almost identical.
And a long history. And by the way, balanced mutual funds and balanced ETFs. But I looked at the which was the one I looked at?
Vanguard's balanced or one of those?
Well, no, I looked at the iShares Core 60/40 ETF. So I wanted to compare ETFs. And its expense ratio is 1/4 of that of the active fund, 0.15.
0.15. Yeah. By the way, your $100,000 in 1928 grew to $439 million by April 30th, 2025. So pretty good growth on that one too. But here's the thing that's fascinating.
But the only problem with that is that if you invested in 1928 in that fund, you're probably dead.
Yeah, that's true. You had to be very
young. You're really
young.
not enjoying it.
Grandpa, can you give me, $100K to throw at this? Anyway, it didn't happen. Okay, but here's the thing that's fascinating. It turns out that here's an example of the Pacer ETF. They went all to cash on March 15th, 2020. Does that sound familiar? March 15th, 2020? Yeah, that's right when COVID was striking. Yeah. The S&P plunged 12% then on the next day. They look like geniuses. And then fell another 6% the following week. So here we are down almost 20%, and they're in cash. These are some really smart people.
Now, the moving average, though, hasn't said anything about going the other way yet, has it?
Exactly. So the S&P rebounds, rising 38% from its March 23 low through June 2, which was the day before the ETF re-entered the market. So it sat there in waiting.
This is the perfect example
of if literally.
You miss a day, you miss a lot.
Boom. I mean, so you missed all of that one day too late before it got turned to dust there. So, and there were periods of time, by the way, in fairness to the people that wrote this article at Morningstar, that where the move to cash appeared to have paid off. April 29th, 2022 to January 27, 2023, it earned 1.4%, while the S&P 500 lost 3.8. So there it outperformed it by 2. But otherwise, according to Morningstar, it was a quote-unquote washout. This just didn't work.
Can I just revert to this crazy little thing called logic? When you're trying to be out of the market when it's down, unless you can absolutely always pick the day or the day or two right before it goes up again, you're destined to lose, if only because the market has tended to rise a lot more than it's fallen.
Yeah, and I think on a monthly basis, it's about 75% months are up, 25% down. Same thing when it comes to
so you're just playing the odds.
Yeah,
if you miss it even by a little bit, you're going to be out of some great markets like they were in 2020.
Yep, it's really tough. And they do admit in this article that hope springs eternal for market timing approaches, but they also admit market timing is difficult, or pardon me, did they say difficult to impossible to pull off? In other words,
difficult to, they did say
impossible.
difficult to impossible.
But here's the thing about people that want to own this fund. One of them is they say some people really hate getting caught in deep market downdrafts. They don't want to see them. My dad was among these people. He hated the idea that, wait, you build a portfolio and you're not doing anything as the market declines. Remember, it's always should be past tense. But that aversion to loss is terrific, but you're going to pay a huge price, as you said, Don, on the other side of that trade, because when the market turns, especially in this system, which seems clunky and slow to me, you're going to miss so much of that upside that it's going to be really painful.
Well, but at least this one has a system. Some of them don't even have a system. It's seat of the pants investing. And, they're trying to, they know when it's going to go up. They know when it's going to go down based on all kinds of indicators that even they probably don't understand. So it's more of a guessing game. And the reality is, if you are out at any time, you could miss some of the very best days in the market. And that right there makes timing an unlikely success story.
Yeah. And again, the reason I brought up the portfolio of 60% in stocks and 40% in bonds, because that's kind of a balanced portfolio, right? Between the riskier things like equities, less risky things like bonds, and has done extremely well since going almost 100 years of data, extremely well. So you've made good money. You've reduced the downside by having all that fixed income. Here's the other thing that is very important in retirement that people have a tendency to forget. If you have 40% of your bonds and stocks go down and you're drawing on the portfolio, you can draw from the bonds then instead of having to sell a security that's gone down, right? So this fund, the idea is to protect you from those big downturns, but you can do that by having the holding of these fixed income instruments, which would include treasuries and some international bonds as well. That is keeping things in place while the stocks are going down at the same time. So you don't need a fancy strategy like this. So Trendpilot, I didn't see how much. Did you look up and see how big it is? I didn't see how much money that they've actually raised for this because it's been around for 10 years. But I'm betting at 60 basis points is still a fairly small number, at least at this point.
It's 3.3.
3.3, but that's in the big picture of things. That's a pretty small fund.
Yeah, 3.3 billion though. It's a pretty good size. I mean, that's not small.
So this is not something that we think you really need, and we dislike market timing in any method.
And again, what it shows is market timing isn't going to do what you want it to do. What you want it to do is have you in when things are going up and out before they start going down. And that's just an impossibility. You've got to give up this magical thinking if you expect to do well over a long period of time. Now, we can always have these periods where guesswork pays off, but have you ever heard of anyone winning in Vegas?
Not for long.
Yeah, but they do.
Yeah, they do.
And why? How do they occasionally win?
They get lucky?
Or cheating.
Yeah.
Luck or cheating.
Okay. Yeah. So,
Anyway.
yeah, thank you for that. We have gotten so many questions, comments, and the like at talkingrealmoney.com. So I'm going to do 3 of them today because we're trying to catch up a little bit.
A triple play.
A lot of triple plays here. Cheryl writes us from Douglas, Alaska. Pardon me. On the May 1st episode, I heard you recommend VTBE. On an earlier episode, VTEB was recommended. Now, VTEB is a fund that I know. According to Cheryl, Google, she says VTBE is in Russia and licensed in Germany. And,
we must have misspoke.
Yeah.
Because it had to have been VTEB, which is the tax-exempt bond fund.
Exactly. That's a municipal bond
fund.
So
we probably just, because we're old, we just had an old moment.
So
Senior
VTEB,
moment.
Which is operated by Vanguard, holds a pretty diversified portfolio of municipal bonds. I do like Vanguard funds a lot, as you know, and we really do like their bond funds a bunch. So yes, Cheryl, you're right. VT or VB. Okay, I'm gonna
see.
Look,
it's not so easy, is it?
VTEB is something we would use and recommend. Did you confuse the letters? Yes. Which is better? We'll go with VTEB, not the Russian
we
fund.
think VTEB is a whole lot better than something you can't even buy.
Yeah, and by the way, we have been out of Russia since the invasion. I think was 3 years. I believe 3 years ago. So we are not investors in Russia. All right. Paul writes a lengthy email from Dallas, Texas. Talk about timing. I listened to your radio show that becomes a podcast while I was in the shower today. Okay, I got to think that through. Anyway,
okay, that's good timing.
I don't know.
We caught him naked?
I don't know. Tom and Roxy took a call from a guy who had a portion invested in a single stock, and they discussed the perils of that. Then I sat down to continue my Series 65 exam studies. Now, the Series 65 allows you to give advice and get paid for it in this business.
So he's studying to be a registered investment advisor.
Apparently so. The topic for the day is diversification. Here's what they said on the Series 65 exam study. Quote, many financial professionals cite diversification as one of the most important investing principles. We live in an unpredictable, chaotic, and changing world. For example, who would have known that 2020 would be the year that drive-in theaters would experience a resurgence, or that the airline industry would take such a large hit? American Airlines stock was trading about $30 per share in November 2019, only to fall to $11 a share. I think that's about a third in November 2020. To put this in perspective, an investor with $100,000 fully invested in American Airlines stock would have less than $37,000 left in their portfolio 1 year later. Mm-hmm. There are endless stories of investors losing significant amounts on concentrated positions in one or just a few companies. Examples include large positions in Enron, Bear Stearns, Silicon Valley Bank, all of which collapsed. For example, George Maddox was a plant manager at Enron that lost over $1 million in his retirement accounts due to Enron's bankruptcy. His biggest fault, lack of diversification. He allegedly held all of his retirement savings, $1.3 million in Enron stock, which had benefited him during the stock's dramatic rise in the late 90s. But his nest egg came crashing down after revelations of Enron's fraudulent accounting practices resulted in the stock becoming worthless. End of quote. As usual, you guys are right on the money. Keep up the good work.
That was a question?
No, it was just a statement. It's a good statement.
You said 3 questions.
Oh, okay. You're right. I did. I misspoke. As usual. One day I'll get all this
VTEB
right,
or VTBE?
I think
Which
it's
one
VTEB.
Are you sure?
I got that.
Is that a question or a statement?
Written it down. Yeah. That's a statement. And by the way, here's the question.
How much a question?
I'm going to give you a question out of this. How much in any individual stock should one person hold?
How much in any individual stock?
Right.
Well, probably no more than a couple of percentage points of your entire
I think
portfolio.
That's fair. Yeah. If you really got to take a flyer on something, sure, a couple percent.
Well, but basically that's what you have if you have a diversified portfolio.
Well, that's
you have
true.
No more than a couple of percentage points in any one stock. So.
Good point. But I did run into somebody
you already own them,
who had were investing in their company stock, not in their retirement plan, but were. And I said, wait, your whole life is dependent on that company for your income. Now you want to throw your retirement into it? No, I wouldn't do that.
Not unless you get a hell of a deal buying it. Now,
well, they always give you the 15% discount or whatever.
Yeah, it's got to be better than a 15.
Oh, where's your number?
It's like 50.
That's 50% off. Good luck. Mark writes us from Lenox, Illinois. Tom and Roxy. She says, we love Roxy. Sorry, Don, nothing personal.
Well, that's it for me. Thanks for a great 40 years, and I'll just
See you
turn it
later.
over to Tom and Roxy now.
Yeah, good luck. I have a 6-figure inflation-adjusted pension and Social Security retirement in 2 years, not including my wife's pension or Social Security. I will likely never need my Roth IRA. I want to leave it to my heirs, so I want to put my foot on the gas for the next 20 years or so. What are your thoughts on 50% in AVUS, 30% in DFIV, and 20% in AVUV? Now, AVUS is large American or U.S. companies, I believe.
Yeah, it is.
AVUV is small value.
Value,
Yep.
right.
DFIV, I'm not sure. Is that international, I'm assuming?
I don't know, but I'm looking it up. DFIV.
DFIV probably operated
Yes,
by
that
our
is their
friends at
International Value Fund.
Yeah.
Why not?
Wow. Let's see. That's pretty good. You're about right on the international side.
Or
You've
you
got
could
good
just
small
kind of
commitment,
do DFAW or AVGE.
which would give you a lot of those same things, but in one fund.
In one fund without trying so hard.
But and they asked, do I need to adjust and add a bit of international small cap, AVDV, or a bit of emerging markets, AVEM, for better diversification and better balance?
If you're going to go with individual funds, then yes, I would add those.
Yeah.
And I would. As
so
a matter
you'd have
of fact,
maybe 10% in AVEM,
which is the emerging markets,
20% in DFIV. That would probably be okay. Well, no, if you're going to add the small value too. So maybe it's 10 in the AVEM, 10% in the AVDV, and 10% in DFIV. That would give you your 30 international. You can stick with the 50% AVUS and 20% AVUV. That gave you pretty good coverage.
I got
just more
so
work.
confused with
There's
all those
a couple
letters.
of V's and D's in there. So, and VTEB. Don't get me going.
AVGE.
AVGE.
I just want AVG. Just get that.
It's easier. Yeah.
It's so much easier. And you get some emerging, you get some small.
And guess what? They do all the work that you're going to have to do to rebalance this. They take care of all that for you.
I forget what is in AVGE.
Let's go. I'll tell you right now. Don't even look. Don't even tell me yet, because I'll tell you right now. It's going to be 70% U.S., 30% international.
Well, okay, hold on.
I think I'm right about that.
70-30, you're right. Yes.
Look at me knowing that.
How about which funds?
Ooh,
This is why I would just buy AVGE, because to build this portfolio on your own would drive you crazy.
9 or 10?
15 funds.
Oh, it's a lot of work. That's truly what you should do, though, if you want to build your own.
Here's what's in it. Ready?
Yeah.
Avantis U.S. Equity.
That's AVUS.
Avantis Large Cap Value.
Yeah, so because AVUS is going to be more growthy than value.
Right.
Yep. Mm-hmm.
Avantis International Equity. Avantis International Large Cap Value. Avantis Emerging Markets. Avantis Emerging Markets Value. Avantis U.S. Small Cap Value. Avantis U.S. Small Cap Regular. Avantis Real Estate. You see, you got real estate.
Good point that you didn't have in here.
The Avantis Mid Cap Equity. The Avantis International Small Cap. The Avantis International Small Cap Value. The Avantis Emerging Small Cap. Look at that.
I'm tired of chasing this around, man. This is a lot of work.
But that is no work, because you just got it. You got all of those funds in the proper allocation.
And rebalanced.
And you get it rebalanced for you automatically. And they charge you a whopping...
How much?
23 basis points for that. 0.23%, less than 0.25%.
All right, you got your answer, Mark. Feel better. So just put it in that one fund, and I think your relatives will be happy with you when they get that money. By the way, they're going to get it tax-free. So why wouldn't they be happy however it's invested? That's just going to be
And by the
awesome.
way, DFAW is very similar, but it only does 5 funds, which, that you're getting a broader diversification through the Avantis ETF.
Yeah. But more work. So depends on how hard you want to work. I like your one fund solution.
AVGE. That's why I love AVGE. I love AVGE.
Before we get away, because there's been a lot of discussion about this in the news, and that is if you work for the federal government.
You don't have a job anymore. Sorry.
I was going to let you say that. You may not, all joking aside, or you may be like, you know what? I don't need to hear this every day. I'm out of here. We've got a special Academy webinar coming up from a couple of guys who know this really well. They're
Academy.
That's what it's called. Appella Academy webinar.
Oh, I thought it was like the Academy Awards.
Oh,
or something.
Well, that too. We'll go to the Golden Globes. I like those better anyway. So on Saturday, the 7th of June, a couple of days from now, at 11 o'clock Eastern time.
Assuming this airs when it's supposed to.
Oh, it better doggone do that. It's a new administration. You stressed, you're frustrated, you're worried. A couple of people that know this really well because they've been helping federal employees for decades are going to be doing this class on pensions, retiring, replacing your paycheck, all that stuff. And they take a specific look at federal employees. So if you're one of those, all you can do is go to appellawealth.com, click on events. It's right there, Saturday, June 7th. 11 a.m. Eastern Daylight Time. This is kind of stuff that we don't spend much time talking about it on the show, but we have a lot of this information that we want to help you with.
What day of the week is that?
I believe that's a Saturday, June 7th.
I hate this when classes are held.
Why? Because you don't like to work Saturdays?
There have been like some really interesting seminars in voice work, for example, and they always hold them on Saturdays.
And you're like, I got a show on Saturday.
I have to do my radio show. I can't attend any of these.
Sorry. I feel bad. Don't they record them? This one will be recorded and placed on the internet at some point.
Then maybe I could watch it later.
Okay. So appellawealth.com, click on events. And thank you all for being part of the show. How's that?
Does that mean we're done?
I think that's it, because all you're going to do is sit around and talking real money, right?
No. First, I was going to tell you to go to talkingrealmoney.com and send in your questions. And if you would like to call in your questions live, do it on Saturdays at 855-935-TALK when I'm not able to go to these seminars and things, because we're on the radio from 3 to 5 taking your questions at 855-935-TALK, which is 855-935-8255. Although, just eventually, we're going to start taking those weekdays, too, taking some calls.
I just realized I had a bad dream the other day. It just struck me when you gave the number where I couldn't remember the number. I was on the show.
Dude, that happens on the show sometimes. That's why I say the number.
VTEB. Got it. Okay. All
right. Now I'm going to say thanks for joining us.
Oh, okay.
And please join us almost every day, because we're here doing this podcast and a radio show. And within them, we're doing something really special.
Really?
Yeah. We're talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.